Hi, everyone. We have dealt with the different aspects under the EPS, where we talked about, of course, the basic EPS and the impact of those, movements in the EPS because of a bonus issue or a right offer or a stock split. We also talked about, of course, the diluted EPS, where we refer to, of course, potential ordinary shares. We talked about, of course, the options and warrants accounting. What we now want to talk about is basically cover the the impact on the EPS with several other things, including, let's say, a contingently issuable shares. Right? There could be an argument where we say that an entity may issue some additional shares on the passage of time. Right? So that kind of a condition would be probably understood that does it bring a dilution impact? Well, it can bring, but then first of all, is there a contingency around it? We don't want to say that, right? So effectively, when I say I'm looking at some conditions which would probably suggest that the shares would only be issued after the passage of time, would not meet that criteria. But anything else, right, wherein there are conditions attached, may have to be considered with respect to the the dilution perspective, if and only if, right? If and only if the conditions have met, right? So what we're saying is that contingently issuable shares are indeed those shares which are issued for maybe for a zero value or with a limited amount of money recovered from the taker of those issues, right? After conditions have been satisfied. Now, they would only be treated as outstanding and covered from the basic earnings per share calculations from the date the conditions are satisfied. As we said, that the passage of time would not call for a contingency, because the passage of time is surely going to happen, right? So that is something that you want to pick up as a part of this consideration, right? Any outstanding ordinary shares that are contingently returnable are again not treated as outstanding. So it is just the other side of the table. We are looking at the exclusion of those. The way we don't include the contingently issuable shares, then the same way we don't exclude the returnable ones there, right? Let's take a very small example around it in terms of how do we understand, or how should we use these for the calculation of let's say the basic EPS. It says that Peter Limited acquires a company during 1718 for a consideration paid in form of shares. Now it says that Peter would issue more shares to the other company in the next year if the profits meet the specific criteria, right? Now these are contingently issuable shares, right? Now you would only consider these for your calculation of weighted average number of shares, provided those targets are met. Otherwise, this would create a lot of volatility into the system, and just to respect that impact of volatility, such contingently issuable shares are not brought into the into the calculations unless those conditions are met. Okay, it's a very simple conceptual format that we should be very comfortable knowing, right? Again, importantly, this is something is in lines with what we had discussed in case of dilution, where we said that in case there are convertible shares, right, or convertible debentures or convertible instruments which are going to be settled in shares, we now want to talk about what if the instruments could either be issued in form of shares or maybe settled in cash, right? We assume for EPS purposes only that the settlement would happen in shares only. Eventually that can happen in cash, but then on the day one, right, when the contract has been issued, wherein the option is there to either settle in cash or in case of in form of shares, we actually assume that the contracts would be settled in cash in form of shares only, and any such number of shares would be considered for dilution purposes, right? That's something we do any which ways for conversion options. So it's the same thought process which is brought here also. Okay. Likewise, when you look at the contracts, the accounting is dealt with under the Ind AS, 32, which is basically the financial instruments framework. That's where it would become, relevant here. So the entity need to accommodate and adjust the numbers. The way, for example, you start looking at this, this is more specifically covered under the, the financial instruments parameter, but broadly, you would want to assume that, this contract would be classified as purely an equity, although there are, complex arrangements where these could result into different, calculations, both for the equity side and also for the liability side. But purely for EPS purposes, we would assume that the contract has been classified wholly as an equity instrument only, right? That is where you start looking at, the references, right? We said that where you look at the settlement of the, the arrangement where the holder has an option to either use shares or cash. In case cash settlement would result in a higher dilution versus a share settlement, then you use the higher of the two. You use more dilution, more dilutive of the two options as far as the measurement of diluted EPS is concerned. Okay, let's take a small example around this and see, are we able to identify or understand the treatment appropriately or not. Right? It says that Happy has issued 1,000 convertible debentures at the start of 2020-21. The debentures have a 3-year term and are issued at a par with a face value of 2,000 rupees, thereby giving a total proceeds of 20 lakh rupees. Interest is payable annually and at a nominal interest of 6%. Each debenture is convertible at any point in time into 500 ordinary shares, right? So what we have is, of course, 1,000 debentures into 500 shares, right? So which gives us, of course, 5 lakh shares there, okay? Happy has an option to settle the principal amount either in shares or in cash. Now, importantly, this is the issuer, and that's where I say, if the option exists, we assume that settlement would happen necessarily in form of shares only, right? Now, when the debentures were issued, the prevailing market interest was 9%, and the present value of the liability comes at 18,48,122. Now, this is again coming from Ind AS 109, which is financial instruments. So you can safely assume that out of this 20 lakh rupees, right, we are saying 18.48 lakh represents liability portion, right? That's what you want to kind of take into consideration. And the remaining would be assumed to be equity only for presentation and accounting purposes, right? It is also provided that the share price is 3 rupees and ignore taxes, right? That's fine for us, right? Now it's also provided further, the normal profit or loss is 20 lakh rupees and the ordinary shares outstanding is 24 lakhs, right? We also provide, of course, the convertible debentures, which is any case given here is 1,000. Now, importantly, the question says calculate the basic and the diluted EPS, right? Now, it would be very straightforward. To calculate the basic EPS, we are given the profit for the year is 20 lakh and the number of shares outstanding are 24 lakh without the impact of dilution. Now, this would be 0.833, right? A very straightforward calculation. But when you look at these debentures converting into shares, and we assume that these would be converted into shares, pretty much like a dilution consideration, there is a change in the profit, right? What I was saying is basically my profit of 20 lakh will increase because I would have been paying interest on the debentures. I'm not supposed to pay, so there would be an interest saving, but my number of shares would change from 24 lakh to 29 lakhs, right? Because that's what we calculated. If the conversion takes place, then the number of shares are 5 lakh. Okay. So what is that amount of interest is something that we just need to calculate, right? We have provided that the liability portion is 18 lakh 48 1,122, and the interest cost is 9%. All we need to do is simply use the calculator, multiply this 1848 122 into 9%, which gives us 166,331. Okay, so this would account for 166,331. Clearly, there is a dilution in place. So we're saying that this would become 21.63 or 21.66, my bad, divided by 29. And that gives us 0.747. Now, this is, of course, the diluted EPS for us. Okay, that is something that we wanted to understand in this case, right? We are just providing the same information that as far as the the total proceeds are concerned, 20 lakh rupees. We take the liability portion out. This is very detailed, by the way, covered under Ind AS 109. So we'll be discussing that in and out. A lot of questions from that as far as the accounting treatment of such convertible instruments are concerned. So equity would be the balancing amount of 1,51,878. Basic EPS is what we calculated already, 0.833. And then we look at the diluted EPS. We calculated that as well. The additional savings of interest on the profit, but the number of shares increasing from 24 lakhs to 29 lakhs, resulting into a dilution in the earnings per share. All right. These are all the calculations. 5 lakh shares, the profit increase, which is 18,48,122 into 9%. And that is something that we are doing. Okay. Now, finally, we are looking at the adjustments with respect to the retrospective changes. We have talked about, of course, Ind AS 8, where we referred to changes in accounting policies, which wants us to go back, make a retrospective adjustment. We also talked about the errors, again, expecting us to do the retrospective adjustment. So we are saying that any dilution, for example, of a previous period should not be restated with respect to changes in assumptions, right? Or for the conversion part. That is something that we do any which ways for the dilution part, right? But then we need to, do the adjustments as far as the impact of the errors or the changes in accounting policies is concerned. We need to make those changes in the prior periods EPS data, right? That's something that we are supposed to do, both for basic and diluted EPS. So all these adjustments, would need to be made as far as the bonus issue or a share split or, similar events which could change. For example, let's say, the context. That's what we did, retrospective adjustments around that. So we bring those retrospective adjustments for any such events, including bonus, stock split, etc. And then we talk about the errors and also the changes in accounting policies, right? Where we change all the numbers, all the relevant numbers are changed, automatically my basic and diluted EPS should also change there, right? So we are talking about the restatements because the number of shares have changed without a corresponding change in resources. Extensively, we have talked about the bonus issue and the stock split also, right? To some extent, the right offer as well, right? And then we need to make those changes with respect to these aspects, and then the errors as well as the changes in accounting policies as well. Okay. Also, in case there is a pooling of interest, then the impact of the business combination should also bring in. This is categorically being discussed under Ind AS 103. When we do that part, we should be able to touch upon the meaning of that as well. Okay. So quickly revisiting, we talked about the diluted EPS, where we talked about multiple things impacting or resulting in the dilution, right? There could be a change in the numerator, that is a profitability, and also the change in the denominator, which is the number of shares. So you bring in all those aspects, warrants, options, contingently issuable shares. We talked about, of course, the convertible debentures, for example, right? And there could be also, stock options, etc. We talked about all these things. And when you do that, including, for example, the shares that might, the contracts that may be, issued in, that may be settled in form of shares or cash. Then we talk about, the conversion would necessarily happen in form of shares. We bring all these things and do the calculation of diluted EPS. Importantly, you want to remember an anti-dilution is not reported, right? It's only the dilution, which is either a reduction in earnings per share or an increase in loss per share. That is something which is going to be resulting into dilution. Okay, right? Final leg, the presentation and discloses, and then we talk about also the key differences between AS and Ind AS. We say that in terms of presentation, you need to present on the face of statement of profit or loss, right? The basic and diluted EPS as far as the continuing operations are concerned, right? And also for the comparative period, right? That's what it is. The EPS is presented for every period for which a statement of profit or loss is presented. Okay, if basic and diluted EPS are both same, then you can actually present it as a single line item, both basic and diluted EPS. That is something which is the flexibility, right? Of course, if there are no ordinary potential ordinary shares, then by default the basic and diluted EPS will necessarily be the same, and that need not be shown separately. Okay, and finally, an entity that has discontinued operations have to also disclose the basic and diluted EPS from the discontinued operation also over and above. It can be shown as a part of notes separately. Okay, and it would obviously be required even if the amounts are negative. Of course, when you say EPS, it includes loss per share. Okay, from the disclosures, you need to calculate and measure everything in terms of how did you arrive at, what is the amount used in the numerator for the calculation of the EPS, reconciliations for the movements, the weighted average number of shares outstanding, and also the denominators. And then you talk about, of course, potential ordinary shares, instrument that could result into dilutions, for example, but they were not included in the calculation, and all those descriptions of transactions that happen after the end of the reporting period, right? And before, for example, the approval of those, right? So these transactions and details also need to be reported. Okay, the final leg here is there, talk about the key differences. Essentially, the two key differences that you want to talk about is Ind AS is far more exhaustive in terms of the disclosure requirements, which is not so required or sought under the AS, right? And as far as the mandatorily convertible instruments are concerned, you do include those upon the conversion from the date of the contract, whereas no such requirement is there as far as the Ind AS is concerned. All right, that's it from my side on this perspective. Thank you very much to all of you. You all have a good day. Bye-bye.